Good morning, children. After understanding our first step of change in profit sharing ratio and the second step, accounting treatment of goodwill at the time of retirement of a partner, now today in this class we will study all 6 steps together in a single question. So here is our topic today, accounting treatment at the time of retirement of a partner with all 6 steps included for accounting. Remember, in the beginning I have told you change in profit sharing ratio, accounting treatment of goodwill, revaluation of assets and reassessment of liabilities, partner's capital account, cash or bank account, and finally the reconstituted balance sheet. So here is a proper question which comes in exam for 8 marks. ABC were partners in a firm sharing profit and losses in the ratio of 5:3:2. This becomes their old ratio. The balance sheet as at 1st April 2019 stood at this position. So here are the assets and here are the liabilities with the capitals of A, B and C. Further, there are adjustments given and here it goes. C retires on the above date and partners agreed that 5% provision for doubtful debt is to be made on debtors. Goodwill is to be valued at rupees 20,000. Stock be appreciated by 10%. Value of building is appreciated by 20%. Sundry creditors is to be paid rupees 2,000 more than the book value. Patents are valueless. And finally, C is paid off in cash. Prepare revaluation account, partner's capital account and balance sheet of the new firm. So this is our question. So we saw in the question that out of the 3 partners A, B and C, C is retiring. And we are going to apply all 6 steps for this question, where the step 1 is change in profit sharing ratio. Old ratio 5:3:2, C retires and the new profit sharing ratio between A and B is 5:3. Therefore, the calculation of gaining ratio by applying the formula new ratio minus old ratio. And since we have discussed this topic previously, the final answer of gaining ratio is 5:3 between 2 partners A and B. So A and B are continuing partners as well as gaining partners. Now in the previous class we have discussed that utility of this gaining ratio is for the accounting treatment of goodwill. The value of goodwill was given as rupees 20,000. Since partner C is retiring, so his share of goodwill come as 20,000 into 2/10. This comes from the old ratio. The share of partner C is 2 and the total is 10. So 2/10 of 20,000 is equal to rupees 4,000. This amount of 4,000 goodwill will be given to C by A and B in their gaining ratio, for which the journal entry goes A's capital account debit 2,500, B's capital account debit 1,500 to C's capital account 4,000, being C's share of goodwill debited to continuing partners in the gaining ratio 5:3. I hope these 2 steps are understood and this is part of working notes. Now in the question balance sheet asset side, there was an existing goodwill at rupees 6,000. So this should always be written off in the old profit sharing ratio among partner A, B and C. So to write off this existing goodwill, the journal entry goes A's capital account debit 3,000, B's capital account debit 1,800 and C's capital account 1,200. To goodwill account 6,000, being existing goodwill written off in old ratio 5:3:2. So we are done with 2 steps, which is part of working notes. Finally, your solution starts from step number 3, where you have to prepare the revaluation account, just like you did in chapter admission of a partner. Nothing new. So after preparing this revaluation account, we are arriving at revaluation profit of 9,600. And this is to be distributed between all 3 partners A, B and C. This is another difference from admission of a partner, where the profit was distributed among the old partners and nothing was given to the new partner, whereas in retirement all 3 are old partners, so this profit is always distributed in old ratio 5:3:2. So this is our step 3 completed. So after the revaluation account is prepared, we are moving with the step 4, which is always partner's capital account. So here is the capital account of partner, where on the credit side, first of all, we will write the capital from the balance sheet as by balance BD for A 50,000, B 35,000, C 25,000. The reserve fund was appearing on the liability side of balance sheet. This will also be distributed between A, B and C in their old profit sharing ratio. This is revaluation profit coming from revaluation account for A 4800, B 2880 and C 1920. Finally, the entry which we have passed for goodwill treatment, where C is credited with these two amounts given by A and B. So by A's capital account 2500, by B's capital account 1500. Remember, the partner who is retiring, in our question C is retiring, will always be shown on the credit side with the goodwill amount. So you must learn it, because this is different from admission of a partner. And since in the journal entry A and B were debited, so you have to go to debit side of A and B and write these two respective amount, 2500 and 1500, and we have to write to C's capital account. So this entry goes A's capital to C's capital 2500, B's capital account debit to C's capital account 1500, and this is the treatment of goodwill through that journal entry posted in the ledger of A, B and C on the credit side. I hope this is understood. This is the basic difference from admission of a partner. So take care of this. Finally, we had written off the old goodwill, that was existing goodwill in old profit sharing ratio. For that, the entry was A capital account debit, B's capital account debit, C's capital account debit to goodwill account, amount 3000, 1800, 1200. And after all these postings, we do the total of the credit side for all three partners, and the same total is written here on the debit side for A, B and C, and then we do the balancing only for the continuing partners. We do the balance CD for them like we did in admission of a partner, but the difference comes for the retiring partner. In our question, it was said C was paid cash on the date of retirement. So we have to write this here for C2 bank account and the balancing amount here. Children, please make note that balance CD will not be done, never be done for the retiring partner. It will be done, but it will not be shown in this head balance CD, because he is no more the partner in the firm. He is retiring, and according to the question, he is being paid the entire amount. So the entry goes C's capital account debit to bank account. I repeat, C's capital account debit to bank account. How do we arrive at this amount? The total 32,520 minus this 1200. So we arrive at 31,320. Now at this point, I'll tell you one more thing. If the retiring partner is not paid the amount, then you will replace this word to bank with C's loan account. I repeat, if in the question it was not mentioned that C is being paid the balance amount, then you will write here, instead of bank, you will write C's loan account. So these are the two different modes of settlement of retiring partner's capital. If he's paid, we write to bank account. If he's not paid, we write loan account with the name of the partner. So two different mode of settlement of the retiring partner's capital account. This amount 31,320 becomes loan for whom? For the continuing partners A and B, and this therefore will appear on the liability side of the balance sheet, and these two amounts will go in the capitals for A and B, A this amount and B this amount on the liability side of the balance sheet. So this is our step 4 completed, partner's capital account. Now we move with the step 5, bank account. This is necessary in this question because there is movement of cash from the business. This balance BD comes from your question. The question in the asset side of balance sheet gave you bank account 33,320. This comes as balance BD, and this payment made 31,320 will be shown here by C's capital account because the money is going out of the firm, 31,320, and the balancing figure comes as 2,000. This balancing figure will finally be going in the asset side of the balance sheet. So we complete step 5, bank account. So after the previous 5 steps, we are finally on our last step for the question, which is the reconstituted balance sheet of partner A and B, the continuing partners, on April 1, 2019. After incorporating all the changes which we have done in revaluation account, this is how creditors stands at. It stands at 27,000. Employees Provident Fund stands at 21,320. The capitals of A and B will be coming from the balance CD of capital account individually and the total here. Then cash at bank we showed in step 5 where it was reduced to 2000 because the payment was made to the retiring partner C, and the other changes in the revaluation account incorporated. Finally, these are the assets appearing: stock 44,000, debtors 8,000, less provision for doubtful debts 400, furniture at 13,000, and land and building at 72,000. This is exactly the same what we did in admission. No change except that the retiring partner is no more appearing here because he has been paid the entire balance amount. And I was telling you that if in the second way the question says nothing was paid to the retiring partner, in that case bank account will not be affected. It will be with the original amount from the question, but here you will show C's loan account. That is the difference. When it is paid, it affects your cash or bank account. When you do not pay anything to the retiring partner, then instead of affecting this bank account, C's loan account, which I was talking about in step 4 of capital account explanation, C's loan account will appear in the liability side of the balance sheet. So these are the two mode of settlement of partners capital account. And this completes our question with all 6 steps, where this is step number 6, balance sheet. Then we have the previous 4 step, right from change in profit sharing ratio to first step, change in profit sharing ratio. You can see here step 1. Then step 2 is accounting treatment of goodwill. Further, we discussed revaluation account in step 3. Step 4 is all about partners capital account. Then step 5 was bank account, and finally the balance sheet. When you attempt this question in exam, revaluation account carries 2 marks. This revaluation account carries 2 marks, and everything above this revaluation account is part of your working notes, which is followed by partners capital account, which carries 3 marks, and finally balance sheet carries 3 marks. So question completes with 8 marks, an important area in every accountancy paper of class 12 for retirement of a partner. So today we have discussed all 6 steps incorporated in one single question. This is how you are going to attempt questions in all 6 steps, keeping the initial part of step 1 and 2 in your working notes and showing revaluation account, partners capital account and balance sheet in your fair part. I hope you have understood today's treatment, and this will make the concept of retirement of a partner complete in itself. Now you require to do this question in your copy, understand it thoroughly, and start doing illustrations from your chapter retirement of a partner with all full questions. Before that, I must remind that you should complete the questions from your book for change in profit sharing ratio as well as accounting treatment of goodwill, and start practicing these full questions. So this brings our class today to an end. Wish you all the best. Keep practicing. Do not be away from practice part in this subject, accountancy especially. Take care of yourself. All of you stay at home. Stay safe. God bless you all.